This is a mandatory disclaimer. We'll just pause here for a little bit. Importantly, investments in securities markets are subject to market risk, and nothing, neither the registration from SEBI, our membership with BSL or certification guarantees performance, either our performance or any product or fund we recommend. And yes, one important part about us as a firm, that is Serenity Wealth, the only income we make is by way of advisory fee from our clients. We don't make any income whatsoever or commissions from any products, any services, any solutions we recommend. So thank you everyone for logging in. Thank you for taking time out today. We have with us Rajesh Bhatia. Rajesh is Chief Investment Officer, ITI Asset Management. A quick background, Rajesh is a commerce graduate from Mumbai's HR College, then cost and management accounting. He did cost and management accounting, and then he also did his CFA from the CFA Institute of USA. Nearly 30 years of experience in the investment industry. Rajesh spent his foundational years with corporate database. For those of you who've been in the markets would know about corporate database and SBC Warburg. And then he set up the portfolio management business for Reliance Asset Management. This was in 2004. And I can say that arguably one of the top performing PMSs of that era. In 2008, Rajesh made a very interesting pivot, and we'll talk a lot about that. He pivoted from the long only to the long short industry, and I will subsequently explain the difference of the two. But before we get there, in 2008, he co-founded and he was the CIO of Heritage India Advisors, which was the Indian advisor to New York-based Heritage Capital and India Long Short Equity Fund. He was there for 5 years. Then he moved to Tata Investments. He was managing their long short proprietary book. Finally, in 2018, Rajesh joined hands with ITI Asset Management and launched their long short fund. This fund has now completed 6 years. In this 6 years, the fund has delivered 129% absolute return as compared to 114% that of Nifty. Interestingly, in no year has his fund lost money, including 1920, which was the COVID year, nor 22-23, which was last financial year. An important disclosure I must make at this moment that I have also invested in Rajesh's fund. Now, Rajesh is one of the rare investment professionals who really, I would say, pivoted from the long only industry to the long short industry. What is long only and what is long short? I'll quickly explain in very simple language before I kind of move to Rajesh. Long only, effectively, all the equity funds, most of the PMSs we know of, are almost fully invested in equities. They may, at points of time, have 5%, 10% max in cash. But in general, the mandate they have from their investors is to be fully invested in equities. And therefore, by construct, by intent, they will move with the broader markets. We all have invested in such funds, and we have experienced how they move. When the markets go up, they will go up in line with the broader markets. Some will go up higher, some will go up lower. When the markets fall, they will fall with the markets, again in proportion. And based on various analysis we do, we try to see which funds fall more, fall less, and rise more. But broadly speaking, they all move with the markets. There are, of course, I've also come across many situations where investors expect these funds not to fall when the markets fall. But as I said, it's neither borne by evidence nor is it really feasible. On the other hand, the long short funds, they are also known as hedge funds in a way globally. Now, there are various formats of long short funds. We won't get into the details there, but broadly speaking, the long short funds are really expected to protect capital at a certain level or not fall as much when the markets are falling. At the same time, when the markets are going up, they are expected to participate in the markets. Now, something which we all wish to do, isn't it? So First and foremost, at this point of time, I would want Rajesh to come in and really ask him that what prompted his pivot from, I think, from a stellar career in Reliance PMS, which, as I said, was one of the top performing PMSs, that too at the height of his career. What made him shift from the massive long only industry to a fledgling long short industry in 2008? Rajesh, over to you.
Great, Ashish. Thank you so much for having this conversation. I really appreciate and enjoy always talking to you, and I'm happy to be on your platform today. Um, yeah, so it's interesting, isn't it? What happened during 2008 when I kind of said that I should move from a long only fund to a long short fund. Well, if you recall, actually my move was in Jan 2008, which was that was the month in which the market peaked. So just before the market peaked, uh, for 5 years, we had an economic expansion in India. It was a great time to be in India. The Sensex went up 7 times. 3,000 का 21,000 हो गया in that 2003 to 2000 Jan 8 period. 7 times the Sensex बढ़ा था. So it was of course a boom, the longest economic expansion that we had seen since independence, at least as far as I recall. The last 3 years of that was 9% GDP growth rate, right? So it was an overheated late stage of an economy, and it was an overheated market as well, right? Reliance, where I was working, ADAG Group, uh, the pinnacle of the peak of that was really the Reliance Power IPO, where I think the market cap was about 1 lakh crore, and the company was a startup. So it was crazy enthusiasm of retail investors. Late stage of an economic cycle, which is always dangerous because if the economy turns, earnings kind of drop. And those are the most dangerous type of markets to be invested in. Um, and the PE has expanded from 15 times to 23 times between June 2007 and Jan 2008. So it was a late stage of a market cycle as well. When I started the firm along with a partner in New York at that time, I said there is madness happening. I told my partner in America, बहुत पागलपन हो रहा है यहाँ, राइट? और यहाँ से आपके पैसे अगर आपको 10% भी मिल गया तो this is a big thing, because I said that from this base I don't know when this bubble will burst, but यहाँ से आपके equity पैसे नहीं बनने हैं. And when I used to say that to my investors, they used to say, यार 15% तो equity में बनना ही है, right? So I said, please do not look at the past to gauge the future. So then I said, I don't want to be benchmarked. I want to be in an absolute return fund where I am benchmarked for if I only see an opportunity, will I make a return? Because I see madness and I don't want to be in a relative game. So as luck would have it, when I started the firm in Jan 2008, it was actually also the peak of the market that happened. And also, my good fortune, because my partner was in America, US. Now, the business that we are talking about, the hedge fund business, is a $4 trillion business. The long short business is a $1.5 trillion business. So, and my investors are all Americans dominantly. So they understood what a long short fund is, which we are trying to still explain in India what a long short fund is after 6 years of our history. They have been used to hedge funds since the 1970s, and they quickly understand what a long short fund does. So it was already a market that my investors in America understood. So basically that's how the journey took place. But I can tell you what happened after. So had you given 100 rupees to a fund, a long only fund in Jan 2008, वो 100 रुपये आपको वापस Jan 2015 में मिलता, राइट? सो 7 साल आपके रिटर्न नहीं बने. आज की तारीख में वो कंसीव करना डिफिकल्ट है गिवन द बुलिशनेस इन द इंडियन मार्केट्स, बट 7 years you did not make any return. In dollar terms, we were actually down 40%. for 7 years, after 7 years. Now, that really was a good thing to understand, because in a long short fund like ours, we did not lose money in 2008. Market fell 55%, right? I told you, the most dangerous markets are when you're at a late stage of an economic cycle and late stage of a valuation cycle. Because when they drop, the market drops can be as high as that 55% that we experienced, which was the worst year in 30 years for Indian equity, right? So basically, when the market fell 55%, we lost about 1.5%. We were there only for part of the time, but we lost 1.5%. Next year, we were in the money. Whereas as a long-only manager, you had not made money in rupee terms till 7 years, in dollar terms, probably 10 years. Now that's a lost decade. Now, I don't know how many people in their 50s and 60s can afford zero returns in equities for a decade, which today is difficult to conceive, but these things do happen in the equity market. So that's really how I started my journey with the long short fund, and I'm glad that it happened that way. Now, just let me kind of, for the benefit of the audience, let me kind of just summarize very quickly what I think is what is the purpose of a long short fund, right? So basically, as you pointed out, Ashish, एक long short fund में आपका पैसा protect हो जाता है, to protect downside protect हो जाती है, and you may still make an equity return, right? See, families after they become rich, right? What they should aspire is, of course, they should aspire for a good return, but they should really aspire for, more importantly, protecting their capital, right? See, I'm reading a very interesting book called The Missing Billionaires, right? अभी 2 दिन पहले मेरे घर पर आई है. And The Missing Billionaires says, there were families like Vanderbilt, the wealthiest person in America. But उसकी families में आज की तारीख में कोई billionaires हैं नहीं. तो हमको सबको पता है कि आपको सिर्फ इक्विटी में पैसा लगाना है और आपका वेल्थ ग्रो होते जाएगा. तो वो बिलियंस जो 90s 100s में था, वो तो आप मल्टी बिलियन हो जाना चाहिए था. बट ऐसा क्या हुआ कि none of these people became multi-billionaires. So even if once you are rich, you don't have to get rich twice. You have to make decisions which are sensible and protect your wealth, right? And of course, grow it at an attractive rate, right? So what a long short does is, it is still making an equity return which is attractive, but protecting your downside. Therefore, it offers uncorrelated returns. So it is uncorrelated to your portfolio. So now, basically, as you navigate markets, once you have money, right, the more uncorrelated bets you have, the more likely your wealth is likely to significantly decline or significantly rise. Of course, your volatility of your wealth becomes less volatile as you move forward. Therefore, you must have as many uncorrelated assets as possible in your portfolio, and this adds to your uncorrelated portfolio, which a lot of people in America understand, which we are trying to educate people on the Indian side.
Sure. No, great. Thanks, Rajesh. And for the audience, we wanted to keep it as an open format session while we have put you all on mute. But in case from now on, at any point of time, if you wish to ask questions, I would like to kind of put up a couple of slides. Post that, we'll move back to Rajesh. But just raise your hand. My colleague Tanya will unmute you. So this is very simple. Nothing. We've taken Nifty 50 as of 1st April 24, and we've just looked at the returns of Nifty 50 in the last 5 years. So this is 11,000 was what was 5 years back, 10 years, 15 years, 20 years, and starting from 1st April 2000. What is interesting is, all through these time periods, if you pull back 5, 10, 15, 20, and 24, you've got CAGR returns ranging between 12 to 14%. Now, this is great. This is what equity is expected to do over long periods of time. If you can move to the next slide, Tanya. Now, this is where the journey gets distorted for most investors. And we've all experienced it, haven't we? For example, now what we have done is, we've just taken some 6 time periods One was from March 2000 to October 2002 when markets fell 44%. And this is, we've taken Nifty. Then there was this period. This is a very interesting period from 6th May to 17th May 2004. This is when the 2004 election results came out, and markets in that 10-day period, markets actually fell about 25%. In a single day, it actually fell 18%. Then, of course, from there, it never looked back for the next 3 years. Then the 2008 global financial crisis. Then 2011 also you had a period in between when markets fell 20%. Then 2018 was around the ILFS bubble, ILFS crisis. And finally, of course, something which we all know of, the COVID. Drawdowns, these are what is called as drawdowns. And Tanya, if you can just pull back. And so what is important as equity investors, and this is something which might sound very cliche, is that one has to hold equities for the longer term. And this is what we've always heard, and navigate these periods of extreme volatility and negative returns without booking a loss. As long as we can do that, we should be fine. So, however, ideal state, and as I said at the beginning, I'm always asked this question, market kya lagta hai? The ideal state for most investors is that, is there a way we can sell when the markets are at a high and we can come back into the markets when they kind of are at the bottom? Now, I have now been in the markets in a way as a wealth manager for about 25 years. What I have seen, most of the wealth management firms globally, they come out with their market views. They give overweight, underweight views. The joke is, and I must share, and this has been said to me by many clients, and in reference to one specific firm they used to mention, that when the firm gave a buy call, they would sell, and the opposite. When they would give a sell call, they'll buy, and they could work in their favor. So I really never saw any consistency in these overweight, underweight calls that I could take bets on the market basis that. Now, Rajesh talked about long short funds or hedge funds. At least from whatever I could see in the global arena, yes, we've all come across some of those legendary calls which some of the fund managers have taken on equity markets, on the currency also. If you remember, in the mid-90s, there was this major transaction on the pound. And some of those fund managers are legends in their own right. But what we've also heard is of massive blow-ups, because many times when you've taken such big calls and when you try to repeat these big calls, you also have the other side of it. So frankly, as a wealth manager, until 2018-19, and frankly, that's when my previous organization where I used to work decided to onboard Rajesh's fund. And that's where in some of these conversations, it came out that there is a way of managing money differently. But until then, my conclusion was that there is no Nostradamus in the investment industry. Just better to buy and hold, ride those waves, invest as much as you can in equities. So Rajesh, how has been your experience? What would you say? Is it possible to predict market cycles? Should not just one buy and hold and basically build those reserves, or they say nerves of steel, to navigate these drawdowns, given the backdrop, what I just gave you?
Yeah, so I think there's nothing wrong with buy and hold as well. I mean, I think as long as you do that sensibly, disciplined, and invest in the right things, there's nothing wrong per se with that strategy alone. But you can, of course, like I said, add to that portfolio and get uncorrelated returns from other strategies as well. Now, to your question, whether it is possible to predict market cycles, there's an interesting book written by Howard Marks, Mastering the Market Cycle, right? And Howard Marks is again a legendary fund manager, and when where he is outlined. So the basic premise is, and which is what we agree with, and which is what we do, is that you can know where you are in the cycle. You may not be able to predict the next steps of the cycle, but आप बता सकते हो मैं कहाँ हूँ, मेरी cycle कहाँ है, right? So whether in terms of valuation we are at a low point, right? Sentiment is bad, corporate earnings are bad, and of course stock markets are also declining, and you can know that you're at a lower point of the market and vice versa. Today, nobody would say that we are at a low point of the market. We are clearly at a higher point of the market. Are we at the highest point of the market? That is the what we are debating. But we are at a high point of the market, right? Valuations today are 21 times earnings. Our average has been 17 times earnings. Sentiment is very high, very positive. A lot of money is chasing mid-cap and small-cap stocks. We know where we are in the cycle, which is we are at a later stages of the valuation cycle at least. So from a mastering the market cycle perspective, you have to know where you're in the economic cycle. You have to know where you're on the earnings cycle. You have to know where you are in the valuation cycle and the sentiment cycle. These are four broad categories. If you understand, you will have a sense of मैं कहाँ हूँ, right? And accordingly, you can reduce or increase your risk, right? So that is what mastering the market cycle does. But we go a step further. So one, you can know where you are in that cycle and gauge your portfolio accordingly. What wealth managers like you do is reallocate, right? So that is what you do basically based on where you are in the cycle. But we go a step further. And we go a step further and say, look, what happens is whenever large declines take place, disproportionate decline takes place, first, from understanding this context or this framework, you are able to understand that the large decline is coming. Now, in my experience, nothing happens when a large decline happens. It doesn't come suddenly, right? The risk for which the large decline is coming, it stays in the market for some time, after which the large decline comes. Let's take the example of COVID, right? Sir, ये COVID-19 था. It was in 2019. मार्केट गिरा कब? मार्च 2020 में, 4 महीने के बाद, राइट? सो जनवरी 15 2020 में चाइना ने अपनी इकोनॉमी बंद कर दी. तभी आपको जागना था कि भाई, to address this COVID, economies have to be shut down. Of course, that has an implication on profits of companies. 80% of our workforce in India is in the unorganized sector, right? So small shops, people, etc. तो अगर वो बंद होगा तो उनकी daily earnings को फर्क पड़ेगा. So, but market reacted in March. So we, as a long short manager, and that's our DNA, whenever a risk is emerging, we kind of keep an eye whether this can disproportionately impact markets. So when we feel that that is the case, giving that framework of the 4 elements that I mentioned and such risk, we are able to fine-tune our assessment of boss large decline aa rahi hai, you need to be conservative. So these are 2 elements that are added. I'll add a 3rd element. Apart from this, you also pointed out there are funds which get kuch right, kuch wrong. Now, how do we make sure that we are right almost all the time, even if it means sacrificing some part of the returns? In our 17 years as a long short manager, no year have we lost more than 2%, 2.5%, right? Worst year in 30 years, we are not losing too much money. So even if it means compromising some part of I don't have to maximize my return, but as long as I'm protecting my downside. So the 3rd layer is, apart from the market cycles and the event based, is basically the process layer. You automatically adjust your portfolio in case you see a decline coming. So that takes away part of the human element also into doing what we are doing. And that's why we've had a successful record for the 16-17 year period that we've been managing this fund. And as you pointed out, fortunately, the ITI Long Short Equity Fund has never had a down year in the last 6 years. And even including the COVID period, when the market was down 38%, we were up. So that framework certainly helps, to kind of navigate the markets like that. And the mathematics of decline, why is it important to do so? Sir, Warren Buffett bolte hain, rule number 1, don't lose money. Rule number 2, never forget rule number 1. Right? And that is because of the mathematics of decline. Like I pointed out, 2008 का example देख लीजिए. अगर आपका 2008 में 55% गिरा, some portfolios were down 70-75%. Capital आते आपका 7 साल लग गया.
Correct.
Right? So आपकी पूरी compounding, long-term compounding, it breaks. Right? So protecting capital is an extremely important element. And that's why Warren Buffett says, rule number 1, don't lose money. Rule number 2, never forget rule number 1, because your long-term compounding gets impacted when you lose such type of disproportionate money. That's why having a insurance in your long-short fund is extremely helpful.
So Rajesh, you frankly make it sound simple. I'm sure it's not so, because so two questions here is one, did you always believe, I mean, you did spend many years of your initial career in managing a long only fund and did a great job there. Did you always believe in this long short? Were you aware of the long short space in general, number one? And when I say, can an everyday investor, when I mean an everyday investor, I mean common investors, be it UHNIs, family office, or the average investor, can they really develop rules around market timing? What are the do's and don'ts if one was to kind of uh, adopt some predictable model?
So, look, I was always familiar with the hedge fund business. So I used to read a lot of investment books, and globally, every rock star fund manager is a hedge fund manager, right?
Okay.
Except Warren Buffett and Peter Lynch, Charlie Munger, Warren Buffett, Peter Lynch. You take any name that you know of in America who's a fund manager. Any fund manager that you've heard of is actually a hedge fund manager. George Soros, Stanley Druckenmiller, Bill Ackman, right? So Seth Klarman. You take any name, Michael Steinhardt, any of them, Jim Rogers, abhi aaye the India mein, all were hedge fund managers. So actually the best managers in America are actually hedge fund managers. They are not long only managers, except Warren Buffett and Peter Lynch that you've heard of. So of course, whenever we used to read on all these people, we used to kind of appreciate how they used to manage. So that's one. So I was quite familiar with the long short space as such. Second, when I started my career, fortunately, I got to see people like Rakesh Jhunjhunwala and Radhakishan Damani from close. I mean, close enough, because they used to be associated with the circle of people I started my career with. And I think there are 3 people who could really do long short: Nimish Shah, Rakesh Jhunjhunwala, Radhakishan Damani. Right? They are the ultimate hedge fund managers. वो लोग भी short करते थे, right? And they knew how to short, and they made disproportionate money playing both sides of the market. And because they had that balance, they had a fantastic sense of where we are in the market. And you can see what they've achieved. Globally, there's a saying, 10 long only fund managers is equal to 1 hedge fund manager. Skill set required is so high.
Exactly.
Skill set in a long short fund manager required is so high. So apart from the global exposure of long short fund managers, I had seen Nimesh Bhai, Rakesh Jhunjhunwala, Radhakishan Damani, all they are the ultimate hedge fund managers of India. And
though not so, I mean, of course, in their proprietary books, but Nimesh Bhai is always known as for the PMS, which he ran as a long only.
Now, his initial years, he was a huge long short guy, and that's how he made the bulk of his wealth. Now he's become so large, and I think he probably doesn't want to spend. It is a high energy, in high intensity business,
and maybe tests your temperament a lot.
Oh,
right?
Of course. But so I had these examples, so I knew it could be done.
Okay. And what can average investors or any investor because most investors, as you just said, like wealth managers like us, would say, okay, allocate so much to equity, so much to debt, do rebalancing, and that's what people tend to do. Or many times their timing calls are not really driven by a method.
So that's why simple people ke liye bataya gaya, don't try to time the market. That's why use SIPs, right?
Yeah.
These are good methods for people who don't know or are not involved. These are better options. right?
Sure.
It's far better an option than to sell at the low point and buy at the high point, which
Sure.
is what a lot of retail investors tend to do, right? They want the कुछ 10 रुपए वाला stock बताओ जो 20 रुपया हो जाए. And typically, this is where the bigger mistakes happen, that they are not able to take advantage of such a great story, which is India, because they
Right.
follow such an indisciplined path to investing, right?
Sure.
So if you can't do this, the better way to do this is at least आप SIP कर लीजिए, right? In extreme side of the cycle, asset allocation change कर लीजिए. Those are at least the second best options that you can do.
Correct. Correct. So what you're saying is that everyday investors or even investors who, but what does it take to develop these skill sets, Rajesh? If there are people on the call who might wish to spend time, energy, resources, one is of course allocate monies to someone like you, but this is something which is always on most investors' mind, right? They're always thinking about markets. Because if it's a buy and hold strategy, you don't need to think about the market. You just buy and hold it, right? And
so this is a business where you really need to read and think, right, and reflect. So to do this, of course, anybody can do it. If I can do it, of course, anybody can do it. But what I'm saying is that it requires some time of studying cycles, some time of, understanding cycles, uh, reading a lot of investment books, trading books at the same time. I'm not saying technicals. I don't even know what a chart looks like, but I'm just saying having the framework to do that. So study markets over a long period of time. What makes it go up? What makes it go down? Have curiosity, and that's the way to you over a period of time develop judgments about how to kind of do this.
so there's one question, Rajesh, which has come. Basically, if you could explain the short part, I mean, so in a way, long, of course, one broadly understands, but how does that dovetail with your larger strategy?
So basically, short is something that buy when you sell first and you in the hope कि price decline होगी and I'll buy it later and वो difference मेरा profit होगा. What you do when you're going long is buy first and sell
Yes.
later, right?
Right.
So this is the corollary or the opposite of that. Every market में कुछ अगर ऊपर जा रहा है, bull market भी हो, there are some businesses which are coming down, right? So if you are able to identify businesses which are deteriorating, right? We all have heard of technology disruptions, which is getting accelerated in the world. People talk about how BlackBerry, became extinct thanks to introduction of Apple. They are my ultimate example, right? Or Kodak, and how Kodak has become an extinct company from being such a dominant company, because now you no longer require those Kodak cameras, and your every handphone has a camera. So technology disruption ho, business cycle ho, excessive competition ho, right? There are reasons why the economics of the business are deteriorating, and the valuations don't reflect it. So we look for an opportunity कि I can make money on this side as well, right? So that's one part of it. In a normal cycle also, I'm finding businesses. So let's say today, paints industry में बड़ा competition आ रहा है, right? One
Right.
player is setting up the second largest capacity, and because of which paint stocks are not going up. For the last इतने बड़े bull market में paint stocks have not done well, right? So because competitive characteristics उसका change हो रहा है, then they are basically those stock prices actually fallen, right?
Correct.
So from time to time, you will have this. Look at broadcasting companies, right? They have actually fallen, right? So why have they fallen? Because the highest advertising now in India, do you know, goes to Google. YouTube लोग आज YouTube ज्यादा देखते हैं, पता नहीं टाटा स्काई कितना देखते हैं, right? So people are moving more towards
It's changing.
from ZTV or those kind of channels to YouTube and Instagram and so on and so forth. So the advertising dollars which the broadcasters were supposed to earn is being shared now. So these companies were very, very dominant in the entertainment business and used to trade at 35 times earnings. Today they are trading at 10 times earnings. Technology disruption, right? So whether it's competitive intensity, whether it's technology disruption, you'll always find businesses that can fall. So it's our job to find those businesses and short them. The second aspect of the shorting is when something like a COVID takes place. Because I'm far more aware of the business cycle, I would be able to short the market and protect my portfolio such that I don't fall. In fact, I make money if possible, even when the market goes down. So that's the second purpose of a short book.
So you're saying a long only fund manager would only focus on stocks which he thinks will go up. But in a long short fund, you have the advantage and you have perhaps the mandate to also benefit from any businesses or industries which are not looking good.
So my canvas is for fundamental analysis is wider.
Wider, yeah. At this moment, I just wanted to ask if anyone has any questions, please just raise your hand. We can unmute you. Or Tanya, why don't you perhaps unmute everyone? Yes, there is one. Mr. Bhanuka has.
I just did.
Yeah, just
We can unmute themselves now, but just a second.
Yeah. Before, just one more question, Rajesh. Given what's your current view on Indian economy, on the valuations, on the markets, really, and therefore, how are you currently positioned as things stand today? But I must give a caveat to everyone. What Rajesh is saying today, how he is positioned, it could be very different tomorrow also. So to that extent, but yeah, that holds true for perhaps as of now.
So basically, I would say that we are in a bull market. So March 23 onwards, we kind of said that the cycle is turning. Why do we know that we are in a bull market? Look at the breadth of participation of sectors. Auto ऊपर गया है, banking ऊपर गया है, NBFCs ऊपर गया है, right? All life insurance, general insurance, domestic pharma, breadth of sectors have gone up. That is a sign of a very strong market. It means that the quality of the market is very good. By the way, we've been saying this for the last 9 months, that the quality of the market is very good. ये मार्केट को हिलाने के लिए या डिस्टेबलाइज करने के लिए कोई ऐसी ऑपोजिंग फोर्स आनी चाहिए और रिस्क आनी चाहिए बिफोर इट गेट्स डिस्टेबलाइज. एंड दैट्स व्हाई वी हैव सेड टोल्ड पीपल बॉस स्टे इन्वेस्टेड, राइट? Don't try to time this market. Let the market give us the color what risk is emerging, and then try to time the market. So one, shorter term, we are in a bull market and it's a very strong market. It requires a strong risk factor to dislodge it. Second, I would say that on a medium term basis, we are in a capex driven investment cycle. देखिए 2020 में क्या हुआ, कोविड का रिस्पॉन्स हर एक गवर्नमेंट का अलग था. डेवलप्ड मार्केट में यूएस यूरोप ने पैसे बांटे, बोला अगर लोगों के पास काम नहीं है तो मैं उनको पैसा देता हूं, वो जाके एटलीस्ट उनकी आमदनी रहेगी एंड दे विल बी एबल टू स्पेंड मनी टू सर्वाइव. इंडिया व्हाट इट डिड इज ऑफ कोर्स वी फीड 80 crore people free of cost, but other than that this Indian government decided कि I will invest in roads and railways. So there has been a very sharp increase in roads and railways. मैं अपना कैपिटल एक्सपेंडिचर बढ़ाऊंगा. सो हमारा गवर्नमेंट का, सेंट्रल गवर्नमेंट का कैपिटल एक्सपेंडिचर बजट एज अ परसेंटेज ऑफ जीडीपी इज एट अ 20-year हाई. सो उन्होंने कहा कि मैं ये करूंगा, मैं मैन्युफैक्चरिंग इन इंडिया करूंगा. तो उन्होंने पीएलआई स्कीम दिए. उन्होंने कहा कि डिफेंस को हम डोमेस्टिकली एनकरेज करेंगे, राइट? सो बिल्ड अ इलेक्ट्रॉनिक मैन्युफैक्चरिंग सर्विसेज बिजनेस, build a semiconductor ecosystem. These have profound implications for our economy. But so capital expenditure has kind of gone up. So power capital expenditure, all of these are basically, so you'll see that the heart and the leadership of the market is all here. And यहाँ हमें लग रहा है कि ये 3 साल 5 साल चलेगा, right? So we are in that kind of a cycle. We are in a bull market. We are also looking for risk factors which can destabilize this market, but we are not able to see it right now. We are not in a bubble yet. There is froth in mid cap and small cap. That is par for the course in the in a bull market. But I would say the large caps are not in a bubble. But I think the way the markets are going up now, I want to see whether the market itself becomes too heavy, and it itself becomes its own. So even if an economic factor doesn't come, whether the weight of the market itself becomes its own enemy. But we are some time away from that. But it's interesting to observe.
And how are you currently positioned? Or Mr. Dhanuka, if you can go ahead first, yeah. There's one, yeah, please ask. I'm not sure whether. So Rajesh, how are you currently positioned in your fund?
So we are net long. I mean, we're net long anywhere between 65 to 75%.
And if you could explain what that means, as in what's the breakup really?
So basically, let's say if I'm long 100 rupees shares, which I think are going to go up, that's long. So
Right,
let's say if
absolutely.
I'm long 100 rupees and if I'm short 25 rupees, so 100 minus 25, 75. So
Right.
that is how this is the net long.
Correct.
So I'm net long 65 to 75%.
Got it. Got it. Yeah. There is one person who's raised hand. You can ask your question, unmute. Tanya, just unmute. Yes.
I did unmute them, yes.
Yes.
I have to ask? Yeah. Thank you, Rajesh. It was really very balanced, comprehensive summary of Indian business and equity market. As a layman, I mean, not a finance guy, I would like to understand what is the broad difference between long, short, and the arbitrage fund, which are dominant in equity space. So, are they not more or less similar type of things?
Yeah, so I think that's a good question. See, the arbitrage funds are always long and short the same stocks. They are making the difference in the futures price. क्या होता है हमारे futures एक हर महीने the most liquid futures are in the next month.
Yeah.
So मान लीजिए कि रिलायंस शेयर है तो रिलायंस का शेयर लेटर से मान लीजिए 1000 रुपए है, राइट? पर अगर वो फ्यूचर्स मार्केट में आप खरीदने जाएंगे तो 1010 में मिलेगा. वो 10 रुपया आपका फ्यूचर्स प्रीमियम होता है.
करेक्ट.
जो आर्बिट्राज फंड कैप्चर करने की कोशिश करता है, क्योंकि वो जो 1000 रुपया और 1010 है, जैसे मंथ खत्म होता है ये लोग दोनों एक हो जाते हैं, मतलब they converge, right? So the arbitrage fund tries to make that 10 rupees. The long short fund is actually could be long, and these are just random names I'm giving. I'm not recommending any stocks, please. Let us say I am long Reliance and I'm short ZTV, for instance. Okay, so these are just names, but I could be long and short very different names. And my objective is not to make only a spread
on long.
My objective is actually to make an equity type return on the upside when the markets are going up and protect the downside in a long short fund.
Rajesh, that I understand, but is it by mandate from SEBI that in a arbitrage fund, equity-based arbitrage fund, you have to necessarily go long and short on the same fund? Is it mandated by SEBI?
Yes.
Okay. I got it now. Thank you. Thank you.
Arun, Tanya, Arun also had a question.
Yeah, I mean,
Rajesh, thanks. It was pretty refreshing one because people usually just talk about bull markets, and invest. So it was kind of a reality check. So that's great. I've my question is around you talked about equity, valuation cycles, and you talked about economic cycles. Now, I think economic cycles, India is in the valuation cycles may be a different story, and economic cycle, we may be at a different stage, right? As a country. And the valuation cycle, of course, I understand it would be stock or share specific, but is there any particular segment that you would say maybe, small caps, mid caps, or large caps that where we are in the late stage of that valuation cycle? I did hear you mention about a late stage on the valuation cycles, and that's where the drop happens, right? Which you talked about earlier. So I think my question is where do you see cracks, or not cracks is a strong word, but valuation cycles, where do you see it to be late stage where there could be an element of overvalue, if I'm making sense?
Yeah, so basically we are at the later stages in mid cap and small cap. There is no question about it, right? In the later stages, are we at the most extreme point that is, I think, debatable. Because like I said, what is also happening is two things. One is the visibility of growth. Let us say I talked about defense. Defense companies के PE बड़े हैं. But let's say defense में आपको 10 साल की visibility भी मिल रही है, right? So it's difficult to say whether now that these valuations have kind of gone up, they are at the extreme point of where they should be. So that's one. So one is, of course, yes, the valuations have gone up. They are at a late stage, but we can't tell you. I can't tell you whether it's at the extreme point where it should drop from here onwards. I cannot make that judgment today. Second is, I would say that, unlike 2008, where we were at a late stage of an economic cycle as well. Fortunately, in this case, we are at the beginning of an economic cycle. We have had 2 years of economic cycle, and because it is an investment-led economic cycle, it will take 5 or 7 years. What does that mean? देखो, price is a function of EPS multiplied by PE. So PE बढ़ गई है और PE नीचे आ सकती है, लेकिन आपके EPS बढ़ते रहेंगे because we are in that economic cycle. तो अगर EPS बढ़ेंगे तो क्या होगा कि PE एक बार आके अटक जाएगी, right? So it's not an extreme downside scenario that I can articulate for you today because we are still in that rising EPS phase. In 2008, we were at a late stage of an economic cycle where earnings dropped. PE भी drop होगा और earnings भी drop होगा. What is the result? 55% drop in the markets. So we are not. Yeah. So we are at that early stage. So those two things are kind of helping because of which I'm not able to tell you whether this is such an extreme point कि यहाँ से आपको सब कुछ बेच के निकल जाना चाहिए. That is not my view at this point.
No, that's helpful. Thank you.
And Rajesh, usually what's the range of your net long, as in what has it been in the last 17 years, perhaps 2008 to 24? Is that
so basically -5, -5, -8.
But for that, which means that short. You were not invested, or you were invested, but you
net short.
Net short, yeah, exactly.
Yeah, so -5 to -8 to about 110%.
So which means, just for the audience, that you might have been holding some long positions out of 100. Let's say, just for argument's sake, 25 rupees, 25% of your portfolio was long. You were invested in stocks, but you were short on other set of stocks by about 30, 35. Therefore, net. Correct. And at the same time, in a scenario, you were also beyond your corpus. You were going beyond, and you had 105% exposure to the markets.
Yeah, but that -5 or the 100 plus is few days, 1 or 2 days. Rest is all in between.
So therefore, by maintaining a 60-70% average long, you are yet able to deliver market returns as compared to
it's an even happier number with 50 to 55% 6-year average net exposure. We are able to beat the market.
Okay, interesting.
We have taken far, far, far lower risk and yet delivering equity returns.
Nice. Sure. And any more questions? This last from my side was, what about your personal investments, Rajesh? If you don't mind sharing, where do you put your money?
So, I mean, basically, I'm assuming you're asking about financial investments. Apart from
financial investments, yes. So apart from
real estate, etc. Apart from the long short, where me and my family own a good portion.
Yes.
My family itself owns a good portion of the long short business. From here on, incrementally, I'm not allowed to buy any stocks, right? And so I have some portfolio which I've held for 20, 25 years. But other than that, I'm now encouraged to invest in our own mutual funds, which, by the way, are doing reasonably well. So quite well, actually. So incrementally, I invest in my mutual funds.
Great. I think thank you so much to everyone for taking time out. Thank you, Rajesh. As always, it was a pleasure talking to you. And
any time for you, Ashish.
Any further questions? Talesh wants to ask? No.
No, I think thanks, Ashish, Rajesh. A good perspective because, as you rightly said, कि market कहाँ लगता है वो सुबह शाम यही चलता रहता है. And as we all know, if you do your homework well, then you can define your risk and participation accordingly. So I think very well put up, and we'll be in touch, and we'll keep taking your views and inputs how one should look at it. Thanks a lot.
Thanks for joining in.
Rajesh, Manish here, Rajesh. Just want
Yeah,
to know, you're such a well-read guy. Any good books you recommend to laymen like us?
So I think the starting point always, whenever anybody joins our firm, we tell them to read One Upon Wall Street by Peter Lynch.
Okay, got it.
And as you advance, I think the books, essays on Warren Buffett are the second best book. And the ultimate best book on investing is Margin of Safety by Seth Klarman. Mastering the Market Cycles by Howard Marks. I've just read a book called Non-Consensus Investing by Rupal Vansali. And I'm reading right now The Missing Billionaire. There are many books. I mean, every time I read a book, I feel, wow, my perspective is expanded. So I like a lot of books, but I think these are really iconic books in the investment field.
Great.
Thanks, Rajesh.
Thank you.
Thank-
Thank you, everyone. Thank you so much.